without any further ado, let's bring you in. Jeffrey is the Raymond James Chief Investment Strategist. So I know you have some interesting charts to show us and tell us about your market outlook.
We got a sell signal on October 2nd. We wrote about it on October 4th in our Monday morning TAC letter, and basically told people if you have long speculative trading positions, you should sell them. We didn't do anything with investment positions because, quite frankly, I didn't think the selling would be as severe as it was into late December. And the selling was brought about through a combination of things. The hedge funds send out letters on November 15th to their investors, and they give them between November 15th and year end to pull their money back. And so roughly 140 hedge funds closed their doors at the end of last year. So that started the selling as hedge funds liquidated. Then you had mutual fund liquidation because they had a tough year last year. And exchange traded funds got sold. And then on top of that, you had tax loss selling. And that led to 3 of the most intense selling days I have seen in a long, long time. And I've been doing this professionally 48 years this month. The selling climax occurred on December 24th. It was followed by a 90% upside day on December 26th, 90% upside day, meaning 90% of the total volume traded comes in on the upside and 90% of the plus or minus ticks come in on the upside. You had another 90% upside day on January 3rd. Folks, that's the way bottoms are made. So all these people talking about a retest of the December 24th low, I don't think you're going to get it. I don't think the market's going to be that accommodative. In the short run, we think the market has exhausted its internal energy on a short-term basis, and we could see a pullback. I don't think it'll be more than 2,500 to 2,550, if that. If we get some kind of trade resolution, it's probably not even going to be that. But longer term, I continue to think, like I did the last time I was on here, that we are in a secular bull market. And secular bull markets last 14, 15, 18, sometimes 20 years. If you can look at this first chart, this 1949 to 1966 secular bull market, you can run the number of years that was. Were there pullbacks? You bet there were pullbacks. The Jack Kennedy steel crisis, where the steel companies raised prices in 1962, President Kennedy said, you can't do that, and put the prices back down. The equity markets didn't like that. And they lost like 30% in a very short period of time, but it did not stop the secular bull market. And so then we peak in 66, and we basically go into this trading range, although it didn't feel like a trading range. When the market in January 73, right there, closed decisively above 1,000 for the first time, it was 1,051. It would start to decline into its nominal price low, the lowest the index would get in December of 1974. In fact, it lost 47% of its value. Now, if your definition of a bull market is up 20%, and a bear market is down 20%. I don't buy that. I guess you could call them tactical bull and bear markets. Between 1966 and 1982, there were 9 tactical bull and bear markets. And then you break out of that 16-year trading range in 82, and you start the 82 to 2000 secular bull market. Were there pullbacks? Yeah. You had the 87 crash. I mean, the Dow lost 22% in one day, but it did not stop the secular bull market. And then you peak in the spring of 2000, and you go into another one of these trading ranges. Although the decline from October of 07 into March of 09, if you own an index fund, an S&P index fund, you lost about roughly 56.4% of your money. But then we come back from March of 09, and we finally break out of that trading range in April of 2013. Now, think about this. Nobody measures the 82 to 2000 secular bull market from the nominal price low that was made in December of 1974. They measure it from when the averages broke out that 16-year trading range between 1966 and 1982. Everybody wants to measure this one from the March 09 nominal price low, when maybe we should be measuring it from when the averages broke out of that trading range, that 13-year trading range in April of 2013. So here's your 13-year trading range, and here's your upside breakout, confirmation of bull market That is what a secular bull market looks like. That's 1982 to 2000, up 1,180%. And there were a lot of stocks that did a lot better than that. Now, one of the things my dad taught me was Dow theory, interaction between the Dow transports and the Dow industrials. Not always right, subject to interpretation, but it's right a lot more than it's wrong. And on September 23rd in 1999, there was a Dow theory sell signal. We wrote about it, told people it's not Jeff Saut, it's not Raymond James, it's Dow theory telling you the best has been seen and discounted. And you ought to raise cash and you ought to not let anything go very far against you. There was a Dow theory buy signal in June of 2003. And then you got another Dow theory sell signal on November 21st of 2007. And then this spike down, and we were bearish at the time, this spike down, the first spike right before the March 09 low, that is October of 2008. And on October 10th of 2008, 92.6% of all stocks traded made new annual lows. I have never seen that happen. I've got data going back into the 50s. I don't think it's ever happened. It might have happened in the 30s. The majority of stocks bottomed in October of 2008. The averages kept going lower because the financials kept going down. But I'm on record in October of 08 saying the bottoming process has started. And then on March 2nd of 09, I don't think Bloomberg still has it, but I think that CNBC still has it. I'm on those two stations saying the bottoming process that started in October is complete this week, and we're all in. And we've basically been running with the bulls ever since. There was a false Dow theory sell signal in May, the flash crash 1, May of 2010. We ignored it because we thought it was an aberration. There was a Dow theory sell signal in flash crash 2 on August 24th of 2015. We ignored it. There was also a Dow theory sell signal in mid-December last year, and we ignored it because we thought them to be an aberration. So I still think we're in a secular bull market. I'm running with the bulls. We're a little cautious on a near-term basis. So where are we now in 2019? Well, the stuff that put us in the tank is just not here right now. Peak oil, not anywhere near $150. Manufacturing is actually coming back in the country. There is no housing glut. There is no excessive bank leverage. The only place we see excess is in the fixed income markets. Now, here's where a lot of people make mistakes. They cut off the 1982 to 2000 secular bull market in 87, but that did not end the secular bull market. It went on for another 13 years. They cut off the 1949 to 1966 secular bull market in 1956 because that's when Egypt tried to take over the Suez Canal, and the markets didn't like it. And they lost a pretty good percentage-wise in a very short period of time, but it did not stop the bull market. So that's what I think we're in. Now, this is the typical investor. They tend to buy in the excitement, thrill, euphoria. The market rolls over. They get a chance to manage the risk, which is the key for a successful investor, is managing risk. But they're told that nobody can time the market. You got to ride everything out. And I'm kind of the opinion that nobody can consistently time the market. But if you listen to the message of the market, you sure as heck can decide if you want to be playing hard or not playing so hard. So I'm one of these people that actually think cash is an asset class, and I don't mind raising cash when I think it's appropriate. And they keep riding it down, and down there at the maximum point, they sell. And I've watched them do it for 48 years. It's the only product that I know of where they put it on sale and nobody wants to buy it. It's pretty amazing. Here's something people aren't talking about either. The number of publicly traded companies has declined noticeably. The Wilshire 5000, when it was constructed, had 5,000 stocks in it. At its peak, it had 7,200 stocks in it. It's now got 3,600 stocks. It ought to be called the Wilshire 3600. So if demand picks up, which it will before the secular bull market's over, there aren't as many companies to invest in as there were 10, 15 years ago. Here's your 30-year bull market, 35-year bull market where the yields fell from 15% down to, I think it was 1.35. And between 1945 and 1982, you had a 35-year bear market where the yields went from about 2% to 15.25%. We think the fixed income market bull market is over. We think the Fed is not going to raise rates very fast, but we do think rates are going to go up. And I don't know if you ever saw the movie Caddyshack, but the judge asked Ty, "What did you shoot today?" And Ty says, "Oh, Judge, I don't keep score." And the judge says, "Well, then how do you measure yourself against other golfers?" And Ty says, "I measure myself by height." So the white line is interest rates. You can see where they peak with tall Paul Volcker. They come down, you get a shorter Alan Greenspan. They come down, you get a shorter Ben Bernanke. And then you get a short Janet Yellen, and rates bottom. And now we got Jay Powell. Proof positive, rates have bottomed. Credit boom is likely to continue. I had a portfolio manager in Seattle about a month ago say, "Well, doesn't it worry you that the Fed's rolling off its balance sheet and the Fed's going to be increasing interest rates?" And I said, "Do you know how much money offshore profits are slated to come back into the country in 2018? And he said, "No." And the number is $700 billion. And that dwarfs anything that the Federal Reserve is going to do. We think you've had some softer economic numbers here, but the economy to us looks real strong. We just don't see all this talk of recession. The participation index indicates that there's no recession in sight for at least 2 years. Inflation is picking up a little, which I think the Fed wants. Business sentiment is strong. It's about as high as it's been since October of 1983. The center chart there is the Consumer Present Situations Index, and it's the highest since December of 2000. If you study that chart, you'll see it has turned down well before any recession, which are those blue bars. Earnings improvement before the corporate tax rate cuts. S&P had an earnings estimate bottom-up operating for the S&P 500 of roughly $141. It looks to us like earnings are going to come in at around 160 to 162. This slide's old. The earnings estimates have come down in recent history. It's around $173 for 2019. But at the recent low, if you use that number, we were trading at about 14.4 times for this year's estimate. So stocks were not all that cheap. And there's a very tight correlation, or R squared, between the direction of earnings and the price of stocks. In fact, correlation is 0.939. That's about as high a correlation as you'll see on anything. I've watched people play games with averages for years. You can pretty much make averages do anything you want, and this is just a demonstration of how it goes. Did you know that the average University of North Carolina geography graduate earns over $1 million more in lifetime income than those from any other school in the country? And this is the reason why. Michael Jordan. Michael Jordan made so much money, he skewed the averages. So when these folks get on CNBC with me and say passive or indexing always outperforms active, it's just not true. They're using active portfolio managers, mutual funds, using the Morningstar 1, 2, 3, 4, 5-star rating system. But if you take out the 1 and 2 stars, the lowest rated one, which you probably shouldn't be buying anyway, active outperforms. And nobody's telling that story. This is a ratio chart. When it's up at the top, that's when active managers have been outperforming passive. When it's down at the bottom where the arrows are, that's always been an inflection point where you should have been pushing money back to active managers. And we hit that inflection point about 18 months ago. Speak to valuations. The chart on the right is the median valuation in March of 2000, 31 times. The median valuation in March of last year was 17.3. Plenty of corporate profits. There are more high growth, high margin companies in the S&P 500 than in the history of it. By definition, valuation should be higher than the historic norms. This is something not many people are talking about. There's been a tectonic shift from tangible assets on corporate balance sheets to intangible assets, which you can't really put on the balance sheet. So what's an intangible asset? Well, Facebook has got 2.2 billion embedded users. What's it worth? It's worth a lot. You can't carry it on the balance sheet as an asset. Here, too, by definition, intangible assets should carry higher valuations than tangible assets. And if you scratch just about any professional in this business, they'll tell you the average PE since 1926 for the S&P is 16.5 times. And that's true. But if you take out the aberrational low PEs in the 70s and 80s that were driven by 22% money market interest rates and 15% inflation, and start with January 2nd of 1990 and get the S&P's price earnings ratio, January 2nd at 91, 92, 93 through January 2nd of this year, the average PE has been 23.85. I'm not telling you we're going to expand to 23.85, but at 14.4 times this year's estimate, if the estimate's right, stocks were not expensive, and we've had the rebound to validate that. PEs have not actually been that good a predictor of price direction. The green line is the S&P 500, and the big bars above the center line are high PEs, and you see what the market did. And below the center line are low PEs, and you saw the market come down. And the reason price earnings ratios may not be as good an indicator anymore is because of the way the new tax code was written. As relates to deductibility of debt, companies are going to be accelerating their depreciation and amortization as quickly as possible. That fundamentally shifts the argument about PE valuations of the market, because if companies are intentionally accelerating and depreciating non-cash items, it basically raises the price earnings ratio to higher than it really is. We think the market has transitioned from an interest rate driven secular bull market to an earnings driven secular bull market, and that flip happened in mid 2015. And this is the return from 1938 through 09. The average return in an earnings driven bull market is 13.1%. And I'm going to stop right there and see if the other folks on this call want to chime in.
All right. Well, first, very compelling argument. As I was talking to you before the show, I tend to share your secular bull market view, and I think we are in a cyclical bear market. I tell you what I'll do, if you don't mind, I'm going to grab the screen and show you a couple of charts.
Sure.
Get your opinion on these. Okay.
Perfect.
So, I'm going to first go back to 1998, because this, in my view, is the last time that we had a cyclical bear within a secular bull. And this was back in September, well, actually late August of 1998, where we broke down below some prior lows. We didn't have the volatility index. Actually, I think we did have the volatility index. I think it did shoot up very similar to what we saw this year. But you can see this reaction high, which went back about 14%. And then we went back down. We did double bottom before we started to break back out again. And if I go to the 1991 cyclical bear market, you can see the breakdown below the prior lows. The reaction high was about 7%, and we ended up going down a little bit below that earlier low in August before resuming that secular bull market. Now, I know you said earlier that, those couple of days that we had back in, I think it was on December 26th, and then again maybe on January 3rd, where you saw more than 90% of the stocks moving higher on days that, obviously we saw some really nice action in the overall indices. Is that the only reason that you're saying that you don't believe we could go back and maybe at least retest those earlier lows, or are there other factors that you're considering as well?
Well, I did a conference call to our financial advisors, with Ned Davis, who I've known since the early 70s. And it's interesting because he referred to those two 90% upside days as breadth thrusts. I think that was lionized by another friend of mine, is deceased, Marty Zweig. And if you study the Lowry service, which I have used for 40 years, they will talk about, when you make a new low and that's followed by two 90% upside days within a 2-week period, it almost always means that was a major bottom. And I happen to agree with that. So I don't think you're going to get a retest of it.
Okay. Now, just to see if I think I have the current picture showing here as well. Okay, I can annotate this and update it for the move that we just recently saw. But currently in this particular rally in the cyclical bear market, and maybe it's over, as you said, maybe that was the end of it. We've currently rallied almost 14%. Is there anything to the downside that would then suggest to you that maybe it's going to be a little bit worse in the near term. I mean, I know the big picture, and I agree with you. I agree with the secular bull market view, and I do think a year from now, 2-3 years from now, we're going to be looking back at this kind of like we look at 2011, 2015, and so forth. I think it's just going to be in the rearview mirror. But is there something to the downside? I know you mentioned 2,500 on the S&P 500 earlier. Is there a point where you'd say, okay, maybe we are going to go down one more time?
As the way we measure the market's internal energy, the internal energy has been used up in that move from December 24th and into that peak that you're showing right there. Okay. So it would not surprise me in the very short run to see the market pull back. And the target zone I had on it, just like on the upside, we had a target zone from the December lows of 2,600 to 2,650. It overshot that last week on alleged favorable trade news out of China. But we stuck with our cautious on the near-term basis because of the market's internal energy not being there. So we think you could pull back to 2,500 to 2,550 and everything would be okay. Now, if there is favorable news coming out of China, the pullback's not going to be that deep. If you get the government restarted, that's probably going to be a step in the right direction as well. But as of right now, and I've been wrong in the past many times, when you make a call and take a stand, you're going to be wrong, and more often than you think. And the real trick for a successful investor is to be wrong quickly for a de minimis loss of capital. So I have no problem saying that was a bad call. But right now, we're cautious on a short-term trading basis. We think the pullback is not going to be all that big, and we think it's for buying.
Okay. There was a couple of questions. Looks like there were a couple questions in the chat room, so I'll just pass these along to you. But one of them was, basically, why are you sure that the low is in? Will the market ignore the GDP hit that is looking inevitable due to the shutdown?
I still think the economy's strong, and yes, you're going to get it. But then you'll have all this pin-up demand when the government reopens, and as you know, it's not totally closed down. Anyway, no, the sequence that you saw was a selling climax followed by two 90% upside days. And it's almost 100% of the time when that sequence takes place, you've made a bottom, and it doesn't get retested.
Okay. I know, too, the volatility index shot up to about 37, and historically that's been a pretty good indication of the baby going out with the bathwater, kind of a bottom that normally gets set in stone. So, all right, another question. Does the political environment bother you at all? In other words, presidential election coming up in 2020, does that factor into your analysis of the market at all?
Not this time. Nobody knows who's going to be running against, Donald Trump, unless they impeach him. So I think it's too far out there to analyze right now, and there's a long time between now and then.
Okay. All right. Well, I know you've only got a couple minutes here. I thought maybe what we'd do is we'd pull up the poll that we were running, and you can kind of give your thoughts. I know you said you're not too concerned about the government shutdown, and honestly, I think the market has already priced all that in. I'm not concerned about that as well. But we did mention a few different things that, what's the biggest threat to the U.S. stock market right now? And in the room right now, U.S.-China trade dispute is the number one. The number two would be from all of that selling that we saw in the fourth quarter, some of the technical breakdowns that a lot of the, as you mentioned, you were expecting the market to top around 2,600, 26 and a quarter. I was looking for the same thing. Aaron was looking for the same thing. So you've got a lot of technical folks that are looking at the market saying, well, it's reached the level we thought, we're going to start selling. So the other, that other comment, bearish technical conditions resulting from the Q4 meltdown, 34% of our viewers believe that is the biggest threat, the technical side of the market. Do you have any thoughts as to what's your biggest threat to the U.S. market right now?
I would say geopolitical.
Okay.
You can't predict what North Korea is going to do. Although I do find it very interesting that he hasn't shot off any more rockets since he and Trump met. I think the selling climax and what you're technically calling a bearish meltdown were people selling into a vacuum. I mean, I talked to a lot of portfolio managers on a daily basis. There was nobody around.
Yeah.
In mid-December. There was nobody to buy them. So it resulted in a selling climax, which is, You don't see a whole lot of them. You saw, in fact, Ned Davis pointed out the same thing you pointed out. In 1998, you saw one.
Mm-hmm.
And in 1957, you saw one.
Right. Right. Well, one thing that's interesting too, I'm a historian of the market, and I think I was mentioning to Aaron last week that the period from October 27th at the close to January 18th at the close is the strongest period historically for the S&P 500 dating back to 1950. And I think last week we needed to close on the S&P 500 above 2658 in order to finish that period higher this year, and we did that. The S&P 500 closed at 2660, or no, right around 2670, I think, versus that
2675.
Yep. So we were actually up in that period again this year, and that marked the 33rd time in the last 36 years that the S&P 500 closed up during that 2-month and 20-day period roughly. So my question, I guess, I know you got to run, but my last question for you, do you pay any attention to the seasonal trends in the stock market?
I pay attention to everything I think will help me predict or forecast where the market's going to go, rather than using the January barometer. So goes January, so goes the year. Lucian Hooper, one of my mentors, longest contributing editor to Forbes, and worked at Thompson McKinnon, where I worked back in the early 70s. And he talked about the December low indicator, and it's real simple. He said if the Dow takes out its December low in the first quarter of the year, watch out. And that's exactly what happened in 2018, and that's one of the reasons 2018 was such a tough year. And with that,
okay,
I'll turn the call back over to y'all.
All right, appreciate it. Thank you for stopping by, Jeff. Always a pleasure to have you on the show.
My pleasure.
You've got a problem. Your investments aren't growing as fast as you'd like. So you did a smart thing. You opened an online brokerage account and started learning more about the financial markets. But now you have a bunch of new questions, like, which stocks should I buy? When should I buy them? When should I sell them? You tried watching the talking heads on the financial channels, but they just gave you untimely advice that the real pros already knew about. It's all starting to feel a bit too little, too late. But what if there was a way to know, to truly know, what the market was thinking and how it was behaving, even before the pros? What if you could learn where the market was headed while there was still time to profit from that knowledge? With StockCharts.com, you can. Trusted by thousands of online investors, StockCharts.com has the charting tools and analysis resources you need to make smarter investing decisions. Our intuitive web-based tools make it easy to create high-quality financial charts in just a few simple clicks. Save and organize the charts you're watching to make managing your portfolio a breeze. And when it comes time to buy, our unique technical ranking system sifts through the markets and quickly points you to the most promising stocks and funds. You had a problem until you found the solution at StockCharts.com. Start your free 1-month trial today and see what superior financial charting can do for you. StockCharts.com, simply the web's best financial charts.
So in the book itself, just so everybody knows, it's all StockCharts charts. It's all stock charts setups. But I talk about why to use candlestick charts, why you might want to use line charts, bar charts, mountain charts like you'd see on the business news networks and those kind of channels. A lot of it is about the settings in stock charts and how to make great charts. This is actually a book about building your base, understanding how to make the chart display the information you want, all of the little trick settings. I think it came out pretty well. So in the book, what I try to do is show how to get things set up, specifically about overlays and indicators, how to turn them on, how to change the settings, how to make them show up the way you want them to. And so if you're struggling with any of the sort of chart settings, that's an important part. With that, thanks everybody. This video will show you how to add a date line to your charts. So if you have a whole bunch of stuff piled up here and you want a date line farther down, there is a way to put it on there and how to move it. So down here under indicators, it's one of the options, date time axis, and by just moving it up and down with these triangle arrows, and notice this little blue arrow that moves with it, it'll help you position it exactly where you want it.